This chart shows the US dollar's share of global currency reserves over the last 2 decades. In the year 2000, the dollar sat at 71%. Today, that share has dropped below 58%. This statistical slide rarely makes the breaking news cycle. Most public attention is occupied by whatever Elon Musk posted this morning. While the headlines focus on short-term noise, the global financial system is steadily rewiring itself in the background. To understand the impact of this shift, we have to look at how international trade functions. Because the dollar is the global reserve currency, any country wanting to buy oil, settle trade deals, or pay international debts must hold dollars to do it. This reserve status is the invisible engine driving the entire United States economy. After World War II, while Europe and Asia rebuilt their economies from scratch, the United States remained the only major industrial power standing. The dollar naturally became the center of global finance. This established a system where even if two foreign nations want to trade with each other, they must maintain dollar reserves in their central banks to facilitate the transaction. This constant global demand creates a captive market for American debt. It allows the US government to borrow capital at extremely low interest rates, an arrangement that saves the country an estimated $200 billion every year. The world eventually accepted this historical accident as a permanent fixture of the global economy. To see how this works, consider a trade between two nations with no connection to the United States. If Brazil sells goods to China, they often cannot exchange their local currencies directly. Instead, the transaction routes through a correspondent bank in New York. This routing gives the US 3 massive advantages. First, intelligence. Processing these trades gives the US visibility into global supply chains, seeing who is buying and shipping goods. The second pillar is investment. Because nations need dollars for trade, they must store their reserves in US Treasury bonds, which forces the rest of the world to fund American debt. The third pillar is jurisdiction. Any transaction touching a New York bank falls under American regulatory power, giving Washington the authority to police or block trades between foreign nations. This infrastructure operates as a mechanical monopoly designed to maintain geopolitical control. For decades, countries accepted this arrangement, but Washington eventually began using this banking infrastructure as an active weapon. The first signs of friction appeared after the 2008 financial crisis, when foreign central banks began questioning the safety of holding their entire safety net in dollar-denominated assets. When the US imposed sanctions on Russia in 2014, Russia and China began building alternative networks like CIPS to process trades without touching American banks. This escalated in 2022 when the United States and its allies froze roughly $300 billion in Russian sovereign reserves. The final escalation involved cutting Russian banks off from the SWIFT network, the foundational messaging system that allows international banking to function. This decision proved to every central bank on Earth that their access to the global economy can be switched off instantly if they cross Washington. Global central banks responded by prioritizing self-preservation. Financial leaders across the world are now actively developing backup plans for their reserves. Nations are building new financial infrastructure with the specific goal of carving a new channel around US jurisdiction. Nations are building these structural bypasses to mitigate the risk of relying on a single, centralized vulnerability. America's absolute monopoly over global finance is ending, replaced by the slow and deliberate pivot away from the dollar seen in the current data. Since 1944, a specific set of international agreements has positioned the US dollar at the absolute center of global trade. The deepest form of this power is commodity pricing. Even when resources like oil change hands between foreign nations, they are overwhelmingly priced in dollars. The dollar acts as the universal reference point, baking it into the cost of nearly every physical good on Earth. Then there is the distribution network. The vast majority of global cross-border transactions are required to route through American correspondent banks. By sitting in the middle of these transactions, the United States secures an immense regulatory choke point and total visibility over global commerce data. You rarely hear about this plumbing in traditional financial media. They cover what gets clicks, things like tech earnings, loud political tweets, or the latest corporate product launches. But underneath all of that noise is a stark reality. Foreign nations do not route their trade through the dollar system because they love it. They do it because they have literally no other options. The dollar operates as an enforced global monopoly by default, and right now, a highly coordinated multi-country effort is underway to dismantle it. The political foundation for this effort is BRICS. This is an alliance of emerging market economies actively cooperating to bypass Western financial dominance. In 2024, the group expanded significantly. They absorbed Saudi Arabia, the United Arab Emirates, Iran, Egypt, and several others. This bloc now represents more than a quarter of the global economy and nearly half of the human population. Before anyone can build an entirely new set of global financial pipes, you need sovereign nations that actually want to connect to them. This massive demographic and economic alignment provides that required foundation, which brings us to a development from 2026 that went largely unnoticed. A project known as the Unit moved from concept to an operational pilot. This visualization shows the proposed structure of this new blockchain-based settlement tool. It is designed as a neutral unit of account, backed exactly 40% by physical gold and 60% by a basket of BRICS member currencies. The specific goal of this formula is to provide the world with a neutral measuring stick. By quoting commodities in this new asset, it actively removes the dollar as the universal reference point. It is a direct, engineered mechanism intended to permanently break the American monopoly on global price discovery. But a new measuring stick requires a physical way to move the money. That infrastructure is Mbridge, which went live in 2024. This flowchart illustrates how Mbridge functions as a cross-border payment platform. It allows member countries to route trades directly with one another, intentionally skipping the central node of a U.S. correspondent bank. By settling transactions through these direct pipes, the long-standing regulatory choke points and the entire data advantage of the United States simply evaporate. Parallel to these technological builds, global central banks have been accumulating physical gold at their fastest pace in modern history, accelerating dramatically since 2022. In early 2023, Brazil and China signed high-level agreements to settle bilateral trade using the yuan and the rial. Later that year, India completed its first-ever purchase of UAE crude oil using Indian rupees instead of US dollars. Now, Saudi Arabia is openly discussing accepting Chinese yuan for its oil sales, actively threatening the 50-year-old petrodollar system. None of these individual agreements, technological platforms, or localized alliances are going to replace the dollar overnight. The actual threat is the systematic introduction of viable alternatives. For the first time in over 80 years, foreign nations are starting to have choices. The multi-decade structural advantage held by the United States relies entirely on forced participation. And when an established system is held together by a lack of alternatives, optionality is what ultimately kills the monopoly.